Hey, Open Trades! How's that echo? Ooh, that would have been a big echo. Oh no. Oh no. Well, I've been doing a lot of thinking, guys. Been thinking I need to make this a little smaller, but I'm a little bit of a superstitious person, I guess. I like to have things a certain way, you know? But I've been doing a lot of thinking. Oh, I forgot. Hey, puppy trades! Wait, I did hiccup. I haven't been doing that much thinking. Um, I think you guys, some of you guys, are going to get your wish. You're going to get your wish. I'm going to stick to stocks. I'm going to stop talking about all this esoteric lore on my page, right? No more esoteric lore. I know. Right? We can't have any more esoteric lore on this page. I get it. You guys just want the facts. Right? So what are the facts? Well, the facts are that coming into this year, we weren't supposed to see very much from the stock market, from big tech, right? Because a man named Jerome Powell, he was going to raise interest rates, and all of the bulls, they were front running the pivot, right? Which was supposed to be not a good idea. Don't front run the pivot, right? Only the MMs get to do that. So around this time, and really for about a 3 or 4 month period, I'm not the guy who says everyone was bearish, but we actually had the highest reading. So there's something called the Commitment of Future Traders Report. I think it's called the CFTC, Net Short Futures Positions. So net short futures positions on the Nasdaq, on the stock market, were the highest they'd been for many years, like over 10 or 15 years, for months during this time. We had extremely bearish, not just sentiment, placings, bets being placed in the markets. Big money, small money. And what happened? Did Jerome Powell lower interest rates? No, I don't think he did. I never heard Jerome Powell come out and say he's going to pause. Did you? We had some softer CPI readings, but really inflation didn't go down. It just kind of stopped inflating. Still inflated, just not as fast as it had been, right? So rates didn't go down. Inflation barely went down. And on a month-over-month basis, prices didn't go down, but the rate of price increases subsided, I guess, right? Not enough for Powell to say he was going to pause. Definitely not enough for him to say he was going to cut. As far as I'm concerned, we've got pretty high rates, 5.25% in a money market account right now. What? 5.25% returns in a money market account right now. That's in a bank. That is in a bank. Holding your money with Chase, 5.25%. What the heck? Powell didn't lower any damn rates. So what happened? That was the official story, right? But there was some esoteric dude on the internet. He took these little lines from the 2018 low and he said 1, 2, 3, 4, 5. Oh wow, Nvidia's between the 61.8 to 78.6% retracement of that rally, right? So there was this big 2018 low everyone knew about. There was this big 2021 high everyone knew about. And then Nvidia got to the 61.78.6% retracement of that move. And to esoteric wave theorist lore, that's where the corrective cycle ends. The new one begins. It goes the length of wave 1, placed at the wave 2 low, and the wave 3 target is met. Very pretty. Looks something like this, you know. I'm not going to go subdivide NVIDIA right now. That wasn't really the purpose of this, but that was all esoteric lore, right? What's the real... NVIDIA announced that they had an AI robot. They were getting into AI, like, here. Really? And then, okay, so AI robots. That's the official story. Doesn't wave theory seem a little more believable than AI robots, right? But that's esoteric lore, guys. Don't you get it? That is esoteric lore. That's not supposed to work. What is this? Right? So what I've been thinking about is, where does the esoteric lore start? Is this esoteric lore? Pfizer, Merck, Home Depot, Advanced Micro Devices, and Royal Caribbean on what I call my favorite screener, 0% implied volatility, ranking percentile, top 200 volume and open interest. Made a lot of money on this one. This one exploded, this one exploded, this one exploded, this one crashed. And the institutions, by the way, this one crashed. We know institutions bought a dip ton of shares against those bloated puts for a rally to a new high. Okay, so that's called a long gamma position. They take a long gamma position, they buy a call and a put when they see it on a screener like this. That's what they're doing. They're buying calls and puts when implied volatility is low. So when Royal Caribbean goes down, they have all these in the money puts, retail gets stopped out, and they get to buy shares that are literally risk-free against those in the money puts, because those puts can be exercised. And if Royal Caribbean keeps falling, then the put delta keeps growing. Okay, so I've gone into the mechanics of what that looks like. I could do it again. I think it's just gonna, get a little off topic. But was this esoteric lore, right? 0% implied volatility, ranking percentile is not the reason that Pfizer, Merck, Home Depot, and Advanced Micro Devices exploded after they were on the screen. Not one of them has the CNBC, Fox Business come out and said, yeah, the reason Pfizer went from 33 to 60 something and hit that equal X target, like that wave theorist dude said was going to happen in 2021, that was because of wave theory and options markets dynamics. No, that's not what happened. It's because we had to, give a bunch of kids, and that's, we saw how that works. 50% of you guys have decided that wasn't a good idea, and you stopped doing it because it was trendy, right? But that was esoteric lore, or was it? Is that sticking to stocks? Is this sticking to stocks? The whole oil sector on this screener. In the this was literally like 3 days before the Omicron variant. 3 days before the Omicron variant. Institutions buy a dick ton of long gamma positions on these oil stocks. Okay? And then the Omicron scare happens, right? So everyone's told we're going to shut down again, right? So retail sells oil, all these big dividend payers. And so institutions have, what do they have? In the money puts that they get to buy shares of dividend payers against that are risk-free. They get to keep collecting shares of these dividends risk-free. And then if oil keeps crashing, the put delta gets bigger and bigger, and they maintain a net bearish position, they still get to collect their dividends. If oil recovers, the put delta shrinks, the call delta grows and grows, and it becomes a net long position. They still get their dividends, and they still get whatever gains they get to what side, right? But that's not why oil technically rallied. That's not why oil technically rallied. The reason oil rallied was because we got a bunch of surprising CPI reports that affected everyone's life. And I said exactly what oil was going to do to the dollar, to the month even. And how many people's lives did that affect? Right? How many of us had to pay a lot more money for gas and just get told a bunch of crap? What about the people in Ukraine? Don't they deserve to know? Wait a minute. It looks like there was something fishy going on in the stock market before your country was surprisingly invaded. So what I'm wondering, what I've been thinking about is where does stick to stocks start and where does stick to stocks end? You know, because for me, I'm really at the point where I'm ready to be done. And I'm not saying be done like, oh, I quit this. I'm saying like I'm ready to be done investing because I'm retired. Like what my job is now is I get a big dividend and I decide where to reinvest it. And, you know, and what percentage is going to pay the bills. That's it. That's going to be my job for the rest of my life. I get a big dividend coming in every 2 weeks. And I'm like, where do I reinvest it to get a bigger one in 2 more weeks? And I had for a long time a chart of SPY. It doesn't look like this anymore. But I had this kind of bull flag marked out on SPY for a long time, where I said basically that a bull flag had formed from this low. In wave theory, we called it wave 1 and wave 2. And I had for a long time written down on SPY, on the chart, if this bull flag is ever back tested, right? The breakout, we hit the equal legs target, breakout and back test. I had written down on the chart, if this bull flag is ever back tested, that is the opportunity of a lifetime. Huge buy were the words written down. So when I saw this bull flag going to get back tested, I acted. I took advantage of it. And people said that I was, you know, jumping ship to dividends because the yields were high and I wanted people to forget about growth or any of that. But I took advantage of this. And my monthly income has grown exponentially. It's still growing exponentially. And it's a nice place to be in. Retired. It's a nice place to be in. I'm not old enough to be retired. I promise. I promise. You know? One of these ETFs that I've been looking at that's been a little interesting. We've had this slide in Apple recently. That's apparently, well, not apparently, been the catalyst for this kind of redness in the market. So this is an ETF called JEPQ. This is a very interesting ETF from JP Morgan. I have the summary prospectus pulled up, but I'm just going to kind of describe why I like it. It's basically, it's not 100% tracking the Nasdaq. They're using, like NVIDIA, they're using like an AI stock picking methodology where they can, you know, pick some stocks that aren't in the Nasdaq. They don't have to have the exact weighting as the Nasdaq. So the bottom line is it's supposed to kind of emulate the Nasdaq, but they have a little bit of leeway. It's actively managed is the other way to say it. They have a little bit of leeway as to what stocks are in it with the allocation, but it's generally tracking the Nasdaq, and it's using at most 20% of its funds to pay a pretty nice dividend from equity-linked notes. So equity-linked notes, the big thing to know is that there's counterparty risk. So they have 7, last I checked, they have 7 different banks that they're using equity-linked notes for. One of them, for example, is the Royal Bank of Canada, right? So there is counterparty risk in theory, assuming that the banks are all equally distributed, which they probably aren't. You know, 1/7 of that dividend is subject to counterparty risk from an individual bank, right? So that's a fancy way of saying that, you know, if the Royal Bank of Canada doesn't pay their bills to, you know, JP Morgan, then JEPQ may not be able to pay its dividend. Right now, we've, you know, this fund's been really impressive, and I've been waiting for it to pull back for a while. We look at JEPQ's dividend history. The Nasdaq is just going to take the most recent distribution and annualize it. So that's a 9.14%. If the dividend is the average of the past payments, it's closer to 10, 11, even 12%. JP Morgan, in their prospectus, they have it listed as 10.6% as of the end of June. So anyway, that's JEPQ. A little interested in this ETF. I think it's actually doing a pretty good job helping to define risk even in the Nasdaq. So it's tracked the Nasdaq a little well, but I think this is an interesting one. I'm also, because really the reason I'm making this video is because I was planning what I'm going to do. I'm getting a big dividend from the Yield Max funds on Tuesday, so I'm planning kind of, how to allocate that. I almost said allocate that. Anyway, one of the funds that I'm going to buy, I'll just read the funds. The funds that I'm planning on buying with my Yield Max reinvestment, PUTW is one of them. SRLN is one of them. UTG is one of them. SVOL is one of them. CLIP is one of them, and then other of those Yield Max funds. But I really want to get into JEPQ and maybe a little bit of PUTW in this video. So for JEPQ, I think the count looks something like this from this low, and this is kind of going to help diagram the Nasdaq, I think. So if we look at the Qs, or if we look at JEPQ right now, I think that this is one of the more useful aspects of Elliott Wave is when an impulse has been identified. So what's an impulse? An impulse means at least 5 waves has formed from a low. So we can actually see that XLK is at a new all-time high. Apple's hit a new all-time high. Microsoft has hit a new all-time high. For a fund that's highly correlated with those, like QQQ and JEPQ, that would also give a little bit of impulse information from this low. But even just looking at this, we have a very clear 1, 2, and then it would have been more perfect if this wave 1 had broken this high, but another wave 1 and another wave 2, and then we can see it began wave 3 of wave 3. So 1, 2, 1, 2, wave 3 of wave 3 begins. And so now what it looks like is we've, kind of confirmed the impulse, so to speak. So now this is a very useful trick or method for defining risk for entering when there's a 3 waves pullback. So I will say you can notice this is the daily chart that I'm looking at. Normally I post about the monthly chart, I post about the weekly chart, and so those are longer time frames. And I've noticed that a lot of people, the longer time frames, it's just they're not very interested in it. But for daily counts, I'm willing to do them, but it's important to know that they're going to get invalidated quicker, and they're also going to they're going to quote unquote work quicker, so to speak. So that's kind of one of the benefits or one of the positives of using this is that I'm going to find out pretty quickly if this ABC correction ends or not. But the negative of that is that I'm really buying JEPQ, when I buy it for the dividends. So, taking a very short term approach isn't really the best idea. But anyway, just defining the risk for JEPQ is going to be very similar to QQQ. 49.48 is the high. So I got that Fibonacci extension tool, and I kind of connected it, but then I'll just go in and make sure it was exact. 49.48, this low right here is 48.17, 48.17, 48.17, almost got it perfect. And then this high right here is 48.92, 48.92. So this is kind of the Elliott wave setup, is that when there's a 3 waves pullback, this 3 waves pullback in this sequence is an ABC correction. So whenever it's 5 waves up, that's 1, 2, 3, 4, 5. Whenever it's 3 waves back, it's ABC. Whether it's a down or an up sequence, I'm obviously focusing on the up sequence right now. So what's kind of the logic behind this? Well, the bears, because remember, Elliott wave is always just knowing what the other side thinks more so than what you think. So Elliott wave, we have to know what the bears think. Well, the bears are going to say for something like this, that this is an A, B, C correction, or that this isn't an A, B, C correction. Sorry, this is a wave 1, wave 2, and then this isn't a wave C, it's a wave 3. So that means we could actually see it go impulse beyond the 161.8% extension. So the logic behind that in Elliott wave theory, it's a little, for a daily chart, getting really picky with the rules is just not a good idea. And it's why I don't like to do that, is because the validation, is quicker. And if I do a daily invalidation, even though, really, I got bullish down here, they'll be like, oh, or, really, if it's, we want to play the when did you get bullish, it was when SPY's in, 290 level. But anyway, I don't, play that, but people do play that, right? So that's why it's kind of, I hesitate to do this, right? 46.80, it's $1 away, right? But there is a, defined risk opportunity. I really think that we're going to see, this ABC correction end. The bulls are going to look for 46.80 to not get broken for JEPQ. If that is broken, then the bears are going to say, or it's going to give more credence to this bear argument. This is a wave A. This isn't wave A. This isn't wave B. This isn't wave C. It's wave 1, wave 2. And the idea is once it goes past 46.80, it would support the idea that we're impulsing to the downside, not to the upside. At least that's what the bears are arguing. Anyway, that's JEPQ. Here is XLK. Just kind of wanted to show, we're getting a little bit of a leading indicator from XLK. And I think that this is kind of one of those charts where, we're in the Elliott wave sequence. The name for this is a series of 3, 4, and 5 unfolding. So basically we have 1, 2, and then 1, 2, and then we enter wave 3 of wave 3. So really kind of the wave personality for this count is that we have kind of these shallow 3 waves pullbacks, and the bears call the top, and then we make a new high, right? That's kind of that classic bull bear debate that you see, but that's really the name for the sequence. So for XLK, I think that this is kind of one of those where, it's looking like a nice little piece of evidence. I think, for the upside target, what would it look like, if we kept going? Well, I think it looks something like this. The minimum target is the length of wave 1, placed at the wave 4 low, right? That would take XLK up to 190, which, I guess since it's a short-term video, that's not too bad. So remember, it's Elliott wave theory, right? I think we're going to see XLK that goes a little below, right? So it's at the 161.8% extension. And I measured SPY a very similar way. It's at the 161.8% extension too. So that's just kind of a guideline. The real reason I'm posting this video is because I think, we're going to see this, kind of short-term correction in. I posted about my hedges and all that in the event that that's not the case coming up. But I think XLK kind of looks something like this. I could really, another way, if you're past the 161.8% extension for an ABC correction, wave 4 can also be found. These kind of stop levels can be found for wave 4, like this. Get the retracement and go up. So wave 4, the guideline is 50%. I'd say for a daily count on an ETF, the 50% retracement is a very useful stop. That's kind of the level if that goes. That doesn't necessarily mean it's crash time, but it means it's probably not wave 4, which means it could be wave 2, which means, look out, I guess. Anyway, 181.46 is the high. So 181.46 is the high. The low is 134.08. So that 50% retracement could be a very useful level right here. It's 157.77. I think for a daily count, that's pretty useful for kind of defining this risk in this uptrend. 1, 2, 1, 2. A wave 3 of wave 3 was broken out into. So I'm expecting that we're gonna see XLK hold above 157. We're gonna see 1, 2, 1, 2, 1, 2. Wave 3 of wave 3 has been broken out of. This is that subdivided wave 3. This is wave 4, and we'll see wave 5. And sorry, that shouldn't be a black 5 up there. That should be a black 3. So the idea is that even when, let's say we get XLK up to the 190s, 1, 2, 1, 2, wave 3 of wave 3. We in wave 3, in wave 4, and in wave 5. In my opinion, that still wouldn't be the end of the sequence. What bulls would be looking for, and this is getting a little, cute, but what bulls would then be looking for is a little bit of a bull flag for wave 4. So that's another reason that I'm looking kind of into, I'm interested in the buy rights and ETFs that sell premium, even if they just sell a little bit of premium, like JEPQ and like PUTW, is because, I am expecting that we're going to have kind of these consolidation periods along the way. That might be a little deep for wave 4, but just the idea that, when wave 3 and wave 4 are ending and we're in that sequence, there are lots of consolidation periods, and especially when we've had this big thrust, a lot of times the premiums are still pretty high. So, that's kind of the optimal, premium collection time. Anyway, I got a little cute 157, nice level for XLK. We hold above that. 1, 2, 1, 2, wave 3 of wave 3 gets entered. We can see XLK up in the 190s. QQQ, very similar. Very similar. I wanted to, maybe get down. Another reason that, I thought XLK was interesting. I think if we look at QQQ, we're very close to that 161.8% extension. This is kind of, what some wave theorists will call it the blue box. Some people will call it, I just call it kind of the hot zone. This is where, this is where the money's made. It's where, the money's lost too, right? So, important, sequence along the way, right? Not one of those you look back and say, where were you when, we pulled back into a shallow wave 4, but it's one of those to, be able to get right now. For QQQ, I think XLK is giving the best level. That 38.2% retracement, 387. Let's get so 387.98. 387.98. And we got 285.19. So if we look at this one, the 50% retracement's a little far. 336 is a little far. That 38.2% retracement, 348, very nice for QQQ. And then just like XLK, the bulls are going to look for, something like this. 1, 2, 1, 2, right? I remember when everyone said, oh, that can't be a nest, right? It's not about being right. But that was 1, 2, 1, 2, wave 3 of wave 3. Very clear textbook, certainly an impulse from a wave theory perspective. We got this big exaggerated wave 3. We're having a little shallow pullback along the way. For QQQ, bulls are going to want to see 348 hold. We could see something like this for the subdivision. And then really a short-term wave 5 target is the length of wave 1, placed at the wave 4 low. That could see, where we get the Qs up, to an all-time high. Right, that's kind of how the count would play out. There's certainly been a lot of leading indicators. XLK, Microsoft, Nvidia, Apple wouldn't be the craziest thing to see. But I think this is how the wave theory would be subdivided. Anyway, I've talked a lot about how I was going to consider or going to buy and am buying an ETF called PUTW. Now, some of the people in the comments might look at the chart and say PUTW is trash, puppy trades. Why would you consider that? Well, PUTW changed the the strategy that it's tracking to this. So PUTW used to very recently, I think it only recently started doing this last October. PUTW started tracking the CBOE S&P 500 1-week put right index. So it's really important to understand that PUTW tracks a completely different strategy than it did, less than a year ago, right? So that's really important. This index then is really for the kind of quantitative purposes. The The what, the performance purposes is really the thing that needs to be measured. But for PUTW, this is it's selling puts on the S&P. Ideally, the bigger VIX spike, which we haven't had a huge VIX spike, but the bigger the VIX spike that we get, the more premium, and that they're going to get from selling puts, and the bigger discount, the shares are going to be. So, if I look at the dividend yield on the Nasdaq right now, it's over 10% right now. It's one. The index has done pretty well for a really long time, and retail traders haven't really had access to it, which is kind of a very similar thing with the options market, and all these covered call ETFs in general. Is that it wasn't too long ago we had QYLD and some other ones that paid quarterly, and that was it. And now that is completely false, and we're seeing a lot of these funds are looking at this, and they're seeing all the money that the asset managers are getting, and they're saying, okay, wait a minute, we got to get on this train now. So PUTW, they also a new ETF called PUTD just released like a few days ago. They're selling options on the S&P 5 times a month, PUTD. So that ETF just came into existence literally 1 day of trading history. But I think that, the index that PUTW tracks looks something like this. I'm looking for, this to be an ABC correction that ended. This is a wave 1 and a wave 2. Very wide, not very useful in validation. Well, I guess that's kind of useful for the long term, 179.44. But I'm scaling into PUTW right now. Looking for, a short-term correction in the market, to subside. I've got my hedges pretty thoroughly covered 3 videos ago. They haven't changed. I am going to have to roll them this week because a good set of them expire. But that's about it. I think that the summary would be, I like JEPQ. As far as levels go, I think that 50% retracement on XLK above 157. This is wave 1 and wave 2. This is another wave 1 and another wave 2. We ended wave 3 of wave 3. We're ending wave 4 of wave 3. We'll enter wave 5 of wave 3 and could see the market at a new all-time high.